Hi guys, welcome back to my channel. Kelvin here. If you have met up with an insurance agent before, you will most likely have heard of something called Investment Linked Plan or ILP. Chances are he tells you that it's a good insurance plan that comes with investment. But you don't really understand what he's saying and you still sign up anyway. A while later, you decided to check out what everyone thinks of ILP, and to your surprise, everyone hates it. The ugly truth behind ILP, why I cancelled my ILP, why we don't advocate ILPs, why ILPs are shit. So, in this video, I want to explain what is ILP, what are the benefits, and why so many people hate ILP. Then, I will share my thoughts on what I think about it. But before I start, I would greatly appreciate it if you can help to tap the like button. In return, I will show you a cute dog. Also, this video is sponsored by Planner B, but more on that later. Okay, let's first understand what is ILP. Basically, it's like this. You got a life insurance, you got an investment, you got ILP. Just in case you don't know what's life insurance, here's an example from AIA. It covers death, total permanent disability, critical illness. If you touch wood have these conditions, they will pay out a lump sum to you. So that's the insurance portion. As for investment portion, each of the insurance company has their own list of funds which you can invest in. For example, this is AIA's list of ILP funds. So whenever you pay money to ILP, some of the money will be used to pay for the insurance portion, then the rest will be used to invest in the funds. This is called allocation rate, and it can change every year. For this example, in the first year, 15% will be used to invest, the remaining will be used to pay for insurance. Then the percentage used for investing will keep going up until year 4, 100% of the money is invested. Then you may ask, no money goes to insurance portion? Is the insurance portion free? Of course not. To pay for the insurance portion, they will be selling your investment portion to pay for the insurance. Okay, yeah, back to the allocation rate. You will notice that at the 10th year, the allocation rate is 102%, meaning the insurer adds another 2% for you. Basically, think of it like a mini thank you gift for holding on to this plan for 10 years. So anyway, that's a simple overview of ILP. Of course, it's a lot more complicated than this, yeah? Now, let's quickly talk about the pros of ILP. First, flexibility in insurance coverage. With ILP, you can adjust the insurance coverage however you want. So let's say if you suddenly have a baby, hopefully it's on purpose, yeah? Then you want to add more coverage. Can, no problem. On the other hand, if you want to reduce your coverage so that your investment can grow, you can do that also. Second, premium holiday. For normal insurance plans, you will need to keep paying on a regular basis. Otherwise, they will just cut your insurance. But for ILP, they have something called premium holiday. So let's say if you suddenly need the money elsewhere, you can stop paying the ILP without any issue. Then they will just sell the investments to pay for the insurance, yeah? Third, liquidity. Since there's an investment portion, you can sell part of the investment and withdraw if you ever need the money. On the other hand, you can also top up more money to the investment, aka buy the dip. So that was the pros. Now, let's talk about why so many people hate ILP. First, fees. This is the chart of all the possible fees. If it looks a lot to you, yes, it's a lot. There's the sales charge, surrender charge, switching fee, policy fee, insurance fee, fund manager fee, and so on. Let's use this plan for example. First up, there's a premium charge. It may sound confusing, but credits to ProHui for explaining this. When you add up the premium charge from regular premiums, in the first 4 years, you are already losing almost 50% of your investment. Then, if you want to sell the funds, there's a 5% sales charge. Also, remember that one of the pros is that you can top up more money anytime? Yes, you can. But there's a 5% fee for each top up. Also, if you decide to go on premium holiday for the first 2 years, there's a $50 charge per month. And if you decide to surrender your plan in the first 2 years, there's a surrender fee. They also have a flat policy fee of $5 per month. On top of that, there's a fund management fee. For example, for this fund is 1.5%. While if you check normal ETFs like the S&P 500 ETF, CSPX, it's just 0.07% fee. By the way, I know I'm using a lot of AIA examples. But it's not because I want to disturb AIA or anything. It's only because the infos are easily available online. That's all, yeah. So, like I said, a lot of fees. When you add up all these fees, you easily be paying 4% or more. Your investment portion needs to return at least 4% just to break even. Otherwise, you will just lose money. But wait, remember that a while ago, after a few years, there's a mini bonus allocation rate? Dollars and Cents did a research to see whether the extra allocation rate helps to cover the return. They compared the performance between buying term insurance and ILP. For ILP, the bonus allocation rate starts from 4th year onwards. And they found out that despite the bonus allocation rate, even after 40 years, the ILP still underperformed. One of the reasons is because of the policy fee. Second downside, insurance charge goes up over time. On the other hand, for term plan and whole life plan, the insurance charge is fixed. For example, the annual premium for this term plan is around $2,000 and is fixed for the entire 45 years. Meanwhile, for ILP, while you are paying the same premium, the insurance charge is actually super cheap at the start, then slowly goes up over time. Around 50 to 60 years old, the insurance charge becomes more expensive than the insurance premium. Which brings me to my third point, investment risk. In ILP, you will be selling your investment to cover your insurance portion. In early years, this is okay because the insurance charge is low. But what if in later years, the market suddenly crashes 50%? It may sound a lot, but it's totally possible, yeah? It happened once in 2007. When that happens, there's a chance that the investment portion is not enough to cover the insurance portion. And you will need to top up more money to pay for the insurance and get charged 5% along the way. If this happens in your 50s or 60s, it will be super bad because your earnings power would have declined. Next downside, investment returns depends on investor. So there's a lot of funds for you to choose from. Do you know which funds to choose? Let's say you choose AIA Global Technology Fund. You will have gotten almost 20% 10 years annualized return. Congrats! You are as pro as Warren Buffett Koko. But if you chose AIA Global Bond Fund, you are only getting 1.5% 10 years annualized returns. Or you'll be losing money due to all the fees. Okay, how about letting the insurance agent choose what is good for you? Let's not talk about insurance agent who sucks at investing. You will confirm plus chop lose money. I have seen agents who are super good at investing. But the question is, will he stick with you for 40 years? Or is there a tiny chance that he will change company or quit his job, then leave you with a noob agent? Okay, let me share a bit more about today's sponsor, Planner B. If you're looking to get an insurance, whether it's life insurance or CashShield Life or integrated shield plan, you can check it out at Planner B. All you need to do is fill in some form to let them know what you're looking for, like what's your preferred plan type, how much coverage you need, what's your budget, and so on. Then, here's the cool part. Planner B will compare between 30 different insurers to come up with the best plan for you. That way, you will get the most optimum plan that suits your budget and needs. Totally at no commitment, yeah? And of course, you will get some discounts or Grab vouchers along the way. So, if you are interested, you can check out Planner B using my link down below. Okay, here are my thoughts. Personally, I don't think that ILP is suitable for most people. It's only suitable for a small group of people who needs the flexibility and is pro enough to manage his investments. For most people, insurance and investments should be kept separate. Investments is to grow your money, while insurance is to protect you or your loved ones if anything bad happens. When you mix insurance and investments together, you will get a suboptimal result. For investment, because of fees everywhere, your returns will be much lower. Rather than investing through ILP and pay a 4% fee, you can just invest through a low-cost broker like Moomoo and just pay $1. That's all. Or if you need help investing, ROBOADVISORS like Saif only charge 0.65% fee to help you invest. On the other hand, for insurance, it's better to get term life or whole life plan for a few reasons. First, it's cheaper, meaning you get more money to invest yourself. Second, it's less risky. Your insurance won't be affected if the market crash. Finally, you might ask, should I cancel my ILP? I'm just a YouTuber, yeah, so I'm the wrong person to ask. Sydney's advice is to recall why did you buy ILP in the first place. If the reason no longer holds true, you can either be more active in the investment aspect, or reduce the number of riders, or relook into your insurance portfolio. I would also suggest talking to other insurance agents for a more professional advice, yeah? But if you do decide to cut, it's better to cut now than cut later. Anyway, that's all for today. Hopefully this video helps you out. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.